Recognizing these layers turns market confusion into a system you can read. March 2023 put this framework to the test. A banking crisis and a tech rally seemed contradictory, until you saw how each force played its part. To understand what really happened in March 2023, you need to look beyond isolated headlines and see how debt, demographics, AI, and crypto work together. The collapse of Silicon Valley Bank wasn't just a story about bad risk management. It was the result of structural pressures. SVB held $91 billion in treasury bonds, and as rates rose, embedded unrealized losses reached $15 billion, enough to undermine confidence when depositors started to withdraw. This wasn't an outlier. Across the banking sector, hidden bond losses totaled $620 billion, a risk that built up because the debt layer of the system required low rates for stability. When inflation forced the Fed to hike, those cracks became visible. Demographics shaped the policy response. An aging population and pension funds dependent on steady returns left policymakers with little choice but to act quickly. The Federal Reserve moved to backstop deposits within days, aiming to prevent a wider credit crunch. But what most missed was how this intervention would channel liquidity into technology stocks first. In a world where workforce growth is flat or declining, productivity gains become essential, and investors know that AI companies are best positioned to deliver those gains. Crypto markets picked up on this shift before the official response. Bitcoin broke above $25,000 on March 17th, even as regional banks continued to fall. Stablecoin reserves expanded that week, signaling that institutional investors were positioning for easier monetary conditions. By the time the Fed expanded its balance sheet on March 22nd, crypto had already rallied more than 30%. These moves were not random. They reflected expectations that liquidity would return, and they anticipated where capital would flow next. AI and tech stocks became the immediate beneficiaries. Companies like Nvidia and Microsoft gained 25% and 18% respectively during the crisis period. Investors weren't simply seeking safety, they were reallocating to firms that could offset demographic drag through productivity technology. The IMS research underscores this, noting AI's unique ability to drive both profits and cost reductions, making these stocks logical targets for new liquidity. Institutional flows confirm the pattern. Data shows that during the crisis, allocations to tech rose as money moved out of banks and into sectors poised to benefit from policy support. This wasn't just speculation. Large funds recognized the structural forces at play and acted accordingly.